Bogleheads Guide to Investing Part 5, Diversification and the Dangerous Trap of Market Timing. In Part 4 we saw that investing is not just a game of choosing funds. Asset allocation, meaning how much money goes into which asset, forms the backbone of the portfolio. We also understood that cost and tax can quietly weaken compounding. Market return is uncertain, but the effect of fees and taxes is very real. But at the end of Part 4, one question remained. If the portfolio is built and costs are kept low, is the investor safe now, or is a new trap still waiting? Imagine a man watching financial TV at night. On the screen, a fund manager is speaking in a confident voice. "We have beaten the market." Glowing numbers below, rising charts in the background, and the anchor's excited voice. The investor feels, this is the chance. If I don't put it in now, I will fall behind. He puts his money into that top-performing fund. For a few months everything goes well, but then that same fund starts falling, and he is left wondering, was the mistake in the fund or in my thinking? Right here the mystery of Part 5 begins. Is the best-looking fund really the best, or is this just a shiny trap of past performance? Bogleheads give a very clear warning at this place. Putting all your money into one stock, one company, one sector, or one hot fund is not wealth building. It can be an unnecessary gamble. There is an old saying, don't put all your eggs in one basket. In investing, this statement is not just a saying, it is a survival rule. If the basket falls, all the eggs can break. If your entire saving is in just one company, and that company fails, then your future can fall along with it. Many companies look very promising at the beginning. Their story is powerful, media coverage is strong, and investors feel that this stock can never lose. But confidence in the market is not a permanent guarantee. Business changes, competition comes, management makes mistakes, and sometimes even the shiniest names break. Diversification means dividing the risk across different places. Stocks, bonds, mutual funds, index funds, and different asset classes together can save the portfolio from a single shock. But here is a twist. Merely buying many investments is not diversification. If all investments are connected to the same kind of risk, you can be diversified on the outside and exposed on the inside. Suppose you have 5 different funds, but all are heavily invested in the same large technology stocks. The names are different, but the risk is almost the same. Real diversification happens when assets behave differently. Some give growth, some give stability, some reduce pressure in a crisis. In Part 4, asset allocation taught us this very thing. Which asset to keep and how much should come out of your goals, time frame, risk tolerance, and financial situation. Part 5 takes that idea forward. Diversification is the wall of the portfolio, but performance chasing can create a crack in that wall. Performance chasing means looking at yesterday's winner and putting money into it today. The investor thinks the fund that was top before will remain top ahead as well. But in investing, past performance is not a guarantee of the future. The fund that is a winner today may become average or even worse after 5 years. The book talks about an old example. In 1970, the 44 Wall Street Fund was counted among America's top-performing funds. Investors were excited to put money into that fund. They were feeling that they had caught the winning manager and winning formula. But by 1980, that same fund went into the category of poor performance. What was once the crowd's favorite became a later disappointment. This story is scary because in this, the investor had not done anything illogical. He did what an ordinary human does, saw a winner and put money into the winner. But the market often punishes popular belief. By the time a fund becomes famous, its best phase has perhaps already been left behind. Financial TV and ads target this very psychology. They show past returns in a dramatic way, so that the investor feels that the opportunity is standing right in front. Looking at professional graphics, confident language, and selective numbers, advice feels very convincing. But many times it is marketing more than education. The investor forgets that the goal of an advertisement might not be building his wealth, but also selling a product. Right here, Bogleheads slow us down. They say behind every shiny performance, look at fees, risk, luck, and timing too. If a manager outperforms for 1 year, is that skill or luck? And even if it is skill, will it repeat for the coming decades? Smart Money magazine held a contest between Ron Barron and Robert Markman. The short-term contest looked exciting on the surface, but the lesson for the investor turned out to be very different. If you followed Barron's portfolio, there was a loss of about 1%, which was better than the S&P 500's nearly 12% decline that year. But if you followed Markman's portfolio, the loss could be very large, up to about 64%. The question was not who was a genius, the question was how the investor would know in advance. A one-year contest can be entertainment, but not a lifetime investing plan. Extracting long-term truth from short-term results can be dangerous. And right here comes the trap of market timing. The investor thinks, I will step out before the fall and come back before the rise. It sounds very logical to hear. Avoid the drop, catch the boom, and smartly beat the market. But in reality, market timing demands being right twice. First, stepping out at the right time, then coming back at the right time. If you stepped out but missed the recovery, the loss will not be just from the fall but also from the missed opportunity. The market's best days often come around scary periods. When fear is at its highest, recovery can begin suddenly. Meaning the investor looks at news and steps out, then waits that, let things become a little clearer. And by the time clarity comes, the market has gone way up. This is the emotional trap of market timing. Fear pulls you out, and regret brings you back late. In part 2, we saw the power of compounding. But compounding works only when money remains invested and time is allowed to work. If the investor keeps stepping out in every panic and coming in with every excitement, he will keep turning off the compounding machine again and again. Part 3 said that inflation is an invisible enemy. Part 5 says that the investor's own behavior can also become an invisible enemy. Greed puts you into a concentrated bet. Fear pulls you out of the market. And both together turn a long-term plan into a short-term reaction. Diversification tries to calm this behavior. When one asset falls and another holds steady, the investor can be saved from breaking in panic. But the benefit of diversification exists only when you give it time. If you run toward the current winner by selling every underperforming asset, the purpose of diversification will end. Many times a portion of the portfolio will look boring for many years. Bonds will shine less, international stocks will lag behind, and value or growth cycles will change. But the job of diversification is not to become a hero every year. Its job is to keep the total portfolio prepared for an unknown future. This unknown future is the most honest phrase in investing. No one knows who the next winner will be, which sector will run, or which country will lead. Therefore, instead of predicting the winner, Bogleheads talk about owning broadly. Not a small portion of the market but disciplined exposure to the entire market. Index funds become powerful due to this very reason. They don't come to say that we will pick the next superstar. They say we will give a broad basket at low cost. When you hold a broad index fund, you participate in the collective productivity of thousands of companies. The failure of any single company does not break your entire future. But still, allocation is necessary. Because even a 100% stock index fund can be diversified, but can also be very volatile. Diversification and asset allocation are different yet connected ideas. Diversification tells you to spread risk. Asset allocation tells you how much to spread it. If your goal is near-term, the volatility of stocks can be dangerous. If the goal is decades away, too much cash can hurt through inflation. Therefore, the deeper lesson of Part 5 is that risk is not just in the investment, it is in the mismatch. The wrong asset is dangerous for the wrong time frame. Now coming back to performance chasing. Top fund lists make the investor feel as if the answer is right in front. But a top list is often a picture of the past, not a map of the future. The one who has won yesterday's race will not necessarily win the next race too. Many fund managers attract more money after a successful period. The fund becomes large, opportunities change, and repeating old performance can be difficult. The investor thinks he is buying a winner, but sometimes he is buying popularity. And popularity is often expensive. Market timing is a trap just like popularity. When the market is going up, everyone is confident. When the market is falling, everyone fears seeing risk. But successful investing often demands the opposite discipline, not overreacting in excitement, not abandoning in fear. This is not easy. No one stays calm looking at a red portfolio. But that very moment is the purpose of a plan. If a plan works only during calm days, then it is not a plan, it is a mood. A real plan shows direction even in a storm. The Bogleheads philosophy is powerful because it does not tell the investor to become a superhero. It says recognize your human weakness and build a system. Diversify so that one mistake does not destroy everything. Do not chase performance so that today's hope does not get stuck in yesterday's winner. Do not do market timing so that panic does not break your compounding. Keep costs low so that a larger portion of return stays with you. And most importantly, connect asset allocation with your goals, not with headlines. Because headlines will not run your retirement, your plan will run it. Now think of an investor who built a boring, diversified portfolio. He sees a hot fund on TV but remembers his plan. The market falls. He feels afraid, but understands that a fall is part of the long-term journey. He does not engage in self-destruction in the name of action. The market rises rapidly. He feels greed, but does not put everything into one hot sector. He does not mistake patience for weakness. This behavior is the foundation of wealth. Money is built not just from the right products, but also from the right reactions. This is the major turning point of Part 5. Diversification is not a shortcut to maximizing returns. It is a tool for survival and discipline. Performance chasing gives you an exciting story, but diversification gives you the ability to endure. And in investing, enduring is half the battle. Market timing gives you the illusion of control, but time in the market gives compounding a real chance. Here, the journey of the whole series becomes visible together. In Part 1, lifestyle improved. In Part 2, compounding came. In Part 3, inflation and index funds were understood. In Part 4, allocation and costs were seen. Now Part 5 says that to save all of these, diversification and behavioral discipline are necessary. Otherwise, despite knowledge, an investor can make wrong moves. But one final question still remains. If the investor is diversified, does not chase performance, and does not do market timing, then what should he do next? Should the portfolio never be touched at all? Is rebalancing necessary? Should allocation change with life changes? And the hardest question, when a real crisis comes, when there is job uncertainty, a market crash or family pressure, how will the investor stick to his plan then? In Part 6, this very final test will open, where investing will become a story not just of numbers, but of patience, rebalancing and lifelong discipline.
अगर इस वीडियो ने आपको कुछ नया सिखाया है या आपको लगता है कि ये जानकारी और लोगों तक भी पहुंचनी चाहिए, तो वीडियो को लाइक और शेयर करना न भूलें। आपकी एक छोटी सी शेयरिंग किसी और के लिए बड़ी और काम की जानकारी बन सकती है। अगर इस विषय से जुड़ा कोई सवाल आपके मन में है या आप अपनी राय हमारे साथ साझा करना चाहते हैं, तो कमेंट बॉक्स में जरूर लिखें। हम आपके हर सवाल और सुझाव को पढ़ते हैं, क्योंकि आपकी राय ही हमें बेहतर कंटेंट बनाने की प्रेरणा देती है। और अगर आप चाहते हैं कि आगे भी आपको बिजनेस, अर्थव्यवस्था और दुनिया से जुड़ी ऐसी ही दिलचस्प और भरोसेमंद जानकारी सबसे पहले मिलती रहे, तो हमारे चैनल GRT बिजनेस को सब्सक्राइब करना न भूलें और साथ ही बेल आइकन जरूर दबाएं, ताकि हमारे हर नए वीडियो का नोटिफिकेशन सीधे आप तक पहुंच सके। GRT बिजनेस पर हम हमेशा कोशिश करते हैं कि आपको सटीक, संतुलित और विश्वसनीय जानकारी उपलब्ध कराएं। हमारी खबरें और विश्लेषण विभिन्न समाचार एजेंसियों, सार्वजनिक स्रोतों और जनमत से प्राप्त जानकारी के आधार पर तैयार किए जाते हैं। हम हर तथ्य को यथासंभव जांचने और सत्यापित करने का प्रयास करते हैं। फिर भी किसी भी संभावित त्रुटि या विवाद की स्थिति में इसकी जिम्मेदारी संबंधित स्रोतों की होती है। हमारा उद्देश्य केवल इतना है कि आप तक जानकारी का सही और भरोसेमंद दृष्टिकोण पहुंचे, ताकि आप किसी भी विषय को बेहतर ढंग से समझ सकें।